A viewer recently told me my stock pick was a failure because it's down 8%. They're right about the numbers, but totally wrong about the bigger picture. Here is why. Welcome back everyone, I'm the Swedish dividend investor. So, a bit of a different episode today. I want to talk about having an investing mindset. So, let's do the voiceover. Now, what do I mean about an investing mindset? Well, mostly I mean a long-term mindset. We'll get to that in a bit. But there's also the importance of seeing the bigger picture and finding your investment style. Like I said, I got a comment on an older video that sparked the idea for this video. As always, this is not financial advice. I'm just sharing my investment journey, my experiences and my own opinion. Make sure to read the full disclaimer in the video description. So, the comment was, so here I am in your future 6 months from when you made this video, and you're down over 8% of STWD value, and if you were lucky enough to own it on the ex-dividend dates of 2 quarters, then you made 5% of your loss back in dividends. So, you're only down 3% during a 6-month period of the market exploding higher. So not so good to say the least. But at least one commenter got it right when they said, stay away from these high dividend REITs. First off, I want to start by saying I actually enjoy this comment. He is right, so I can't argue with that. I also want to encourage you guys to always be skeptical of finance YouTubers, and that includes myself. I always try to show you guys my thinking process, and I try to be as transparent as I can be. Apply skepticism and your own critical thinking. I never say,
you guys should buy this.
I often talk about stocks or ETFs I want to own, and I show you my process of selection. But I often say, see how it fits you. Investing is very individual, as we know. So, that brings us to his points. Yes, I am down on STWD Property Trust. I have shown that in my monthly income videos, and compared to the S&P in the same time frame, my performance gets smoked. Here's the part with the bigger picture. How large is my holding in STWD? How many stocks and ETFs do I hold? How long is my holding period? How is my performance? What's my investment style? I do think it's relevant for context. So, let's start with my holding in STWD. It is currently 1.27% of my invested capital or book value. It's 1 out of 27 holdings. Looking at my investment in dollars, I've invested $1,987 and my loss is currently bigger than when I got the comment, currently about 10%. It amounts to $201 in losses, but I also collected about $115 in after-tax dividends, so the unrealized loss is now $86, with a portfolio size of $160,000. That's a loss of about 0.054% of my total portfolio value, and remember, that is unrealized, meaning it's not realized until I sell. My holding period is between 5 to 10 years initially. Things can change. I could see a better opportunity and move my capital, or, as you have probably seen, I do sell stocks when I made a decent profit. So, I'm not a buy and hold forever guy, but I do realize sometimes it can take a while for an investment to pay off. So let's talk about my performance. Let's check my compound annual growth rate, CAGR, on my broker. I do use Google Translate, so some things will look weird. Since the start of my portfolio, September 2020, I've had some highs and some lows. Let's take a look at around 2023, where my portfolio and investment style matured. I had a low point of 8.52% in October of 2023, a high of 13.32% in July of 2024, and I'm currently sitting at a 12.61% CAGR since the start. Keep in mind, I held a lot of single stocks before, and I have always been biased towards higher yields. I've said it before, and I will continue to say it. I don't care about outperforming. I just want to perform. If I can stay in a range between 8 to 12% year in and year out, with realized gains in the form of dividends and distributions, I am very happy. Just a quick reminder, have you actually checked if you're subscribed? I've been there many times, thinking I was subscribed only to find out I wasn't. So make sure to check it. Thanks. What about S&P during the same time frame? In nominal returns, 16.42% CAGR. That is awesome. But you get around 1% in dividends. That is fine for some, but it's not my investment style. I like the freedom of dividends and the flexibility to reinvest how I choose. Or I can just take the income and buy a trip to a warm country. The income investment style keeps me in the market. It motivates me to keep investing and it gives me some freedom. Maybe some of you don't like that type of investment, and that is fine. You do you. All I'm trying to say is find your style, keep at it, filter out the noise and see the bigger picture. Zooming out on S.W.A.N, since 1993, they have a CAGR of 10.78%. Some periods it will be higher and some lower. That's why I said, if I can get between 8 and 12%, I am very happy. So, how about we all take a step back and just stop over focusing on short-term performance? That's the bigger picture of investing. Yes, STWD is down quite a bit. So were many of my best investments as well. And I don't care. If nothing changes in the fundamentals, I don't care. That brings us to a long-term mindset. A lot of my returns come from dividends, and compounding dividends takes time. I'm fine with having some position underperform for some time, as long as my entire portfolio keeps compounding over the long term. A short-term focus is looking at the performance of a single investment over a 3 or even 12-month period. Sure, if something has gone down 90% in 12 months, we really messed up. But we are talking about a short-term performance of around -3%, as the commenter suggested. Should that make my decision if I messed up? Do I sell? No. I simply hold it and let the dividends take care of the compounding. Let's say they keep going down 1% in share price per year from now. Since my yield on cost is over 10%, I would be in the green after holding it for a year. What about 5 years? I hope you get the point. They could also recover and blast 10-15% higher in a few months. Who knows? No one does, and that's the point. My focus is on dividends, realized returns, something I can count on, instead of crossing my fingers and hope the market climbs higher. Now, mortgage REITs aren't my favorite, even if this is a hybrid REIT. But we can compare STWD with S&P 500 since the start of my main portfolio. We can see STWD in red was outperforming S&P in blue since 2021 until mid-2025. Does that mean the S&P 500 suck and you should sell it? No. The S&P beats STWD since their inception. It's just a different style of investing. One thing I like about my portfolio is the lower volatility I get through the dividends. For some context, let's look at my broker again. 2022 wasn't a disaster for me. The Trump tariff wasn't that bad. And when the US-Iran BS started, my portfolio held up pretty good. So I might not get those crazy returns when the market is blasting higher, but I sleep well at night. And to me, my friends, that is priceless. So to wrap it all up, guys, here is what it really boils down to. Focus on the big picture. Don't get distracted by a single line item. STWD being down a couple of % in 6 months isn't a disaster. It's just $86 unrealized loss in a 160k portfolio. Zoom out. Focus on total portfolio compounding. Don't obsess over short-term price noise. Short-term market swings will happen. If the business fundamentals haven't changed, a temporary dip isn't a reason to panic sell. Focus on your investment style. Don't compare your strategy to everyone else's. Yes, the S&P 500 might beat my portfolio in pure capital appreciation during a bull run, and that's great. But I invest for cash flow, flexibility, and staying motivated in the market. Focus on realized returns over time. Don't try to time short-term market pops. Dividends take time to build momentum, but they give you income you can actually count on, whether you want to reinvest it or go on a vacation. Paper gains are just paper gains. You won't get anything until you sell. At the end of the day, apply critical thinking, filter out the noise, find the strategy that keeps you in the game, and let time do the heavy lifting. I hope I didn't ramble too much, guys, and that this might help you think more like an investor and less like a speculator. Let me know if we share the same investor mindset, whether we invest for dividends or just go with the S&P and chill. Thanks for tuning in, guys. I hope your weekend was great. I will see you in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!